Stop everything you're doing right now. And I mean everything. Put down your phone, close that laptop. Tell whoever you're with that you'll talk to them in 10 minutes. Because what I'm about to show you is so urgent, so critical, so mathematically impossible to ignore that if you don't understand this in the next few minutes, you're going to wake up one day soon and realize you missed the biggest warning signal of your entire investing life. Ladies and gentlemen, Asian guy here. Today is January 16th, 2026. And we need to talk about something that's happening right now in the silver market that has never ever happened before in modern history. Something so dramatic, so mathematically significant that when I show you the numbers, you're either going to think I'm crazy or you're going to realize that the entire silver market is about to implode. I'm talking about the vault exodus. I'm talking about physical silver disappearing from major exchange warehouses at a rate that defies logic. I'm talking about 127 million ounces. That's the total registered inventory left in major Western vaults, being hunted by delivery demands that could drain those vaults to zero in a matter of weeks. And when those vaults hit zero, when there's no more physical silver available for delivery, the paper market dies. The price goes vertical, and everyone who's holding paper instead of physical metal is going to get destroyed. Let me show you exactly what's happening. Let me give you the verified data. Let me prove to you that we are not talking about speculation anymore. We're talking about a mathematical certainty that is playing out in real time. Here's what you need to understand first. There are two types of silver inventory in major exchange warehouses. There's eligible and there's registered. Eligible inventory is silver that meets the quality standards and is sitting in approved warehouses. But it's not available for delivery against futures contracts. It's just sitting there. Maybe it belongs to investors. Maybe it's backing ETF shares. Maybe it's private storage. But it's not up for grabs. Registered inventory is different. Registered inventory is the silver that's actually available for delivery. When someone buys a futures contract and decides they want physical metal, this is where it comes from. This is the ammunition. This is the reserve that backs the entire paper market. And according to verified exchange data from January 7th, 2026, there are only 127 million ounces of registered silver left in major Western exchange vaults. Let me say that again. 127 million ounces. That's it. That's all the physical silver that is actually available to deliver against the hundreds of millions of ounces worth of paper contracts floating around the system. Now you might be thinking, okay, 127 million ounces sounds like a lot. But here's the problem. It's not a lot, not even close. Let me show you why that number should terrify you. According to market analysis from January 7th, 2026, on that single day, contract holders received delivery of 8.1 million ounces of silver. That's one day. 8.1 million ounces delivered out of warehouses. But here's where it gets insane. Despite that massive delivery, despite 8.1 million ounces leaving the system, the open interest for January contracts actually increased by 1,131 contracts. Each contract represents 5,000 ounces. Do the math with me. Open interest went up by 1,431 contracts. That's 7.2 million ounces worth of new demand. On the same day that 8.1 million ounces were delivered, so on a day when the system should have been exhausted, when traders should have been satisfied, when delivery pressure should have eased, instead, more people lined up demanding physical metal. This is not normal. This has never happened before in the history of silver markets. This is a delivery rush. This is a bank run happening in slow motion. This is every contract holder simultaneously realizing that paper contracts are worthless and only physical metal matters. And if this continues, if delivery demands keep accelerating like this, those 127 million ounces are going to be gone in weeks. Not months, weeks. Now let me show you the bigger picture, because what's happening at major exchanges right now is just the tip of the iceberg. According to verified commodity research, exchange inventories have been draining for months. From their recent peak, major exchange silver warehouses have fallen by nearly 70 million ounces. 70 million ounces gone, vanished, delivered, removed from the system. And it's not just exchange warehouses. According to verified reports, for the first time this decade, major ETF holdings saw a 3 million ounce withdrawal from custodian vaults. The first meaningful withdrawal like this in the 2020s. Something is stirring. The smart money is moving. Institutions that understand what is coming are pulling physical metal out of the system as fast as they can before the vaults go dry. And here's the most terrifying part. According to leading commodity analysts, the world is facing the deepest silver supply deficit ever on record. Approximately 295 million ounces for 2025, when ETF flows are counted. The cumulative silver deficit since 2019, over 1.3 billion ounces. 1.3 billion ounces. That's not a shortage that gets fixed with a good quarter of mine production. That's a structural hole in the market that's been building for years. and now it's reaching the breaking point. Let me explain what's actually causing this vault exodus, because this isn't random. This isn't market noise. This is deliberate, calculated positioning by people who know exactly what's coming. First, there's the tariff situation. Even though the administration delayed tariffs for 180 days, that delay didn't eliminate the threat. It postponed it. And industrial buyers know that when those tariffs eventually drop, imported silver could become 25% to 50% more expensive overnight. So what are they doing? They're securing physical metal now. They're standing for delivery on futures contracts. They're pulling silver out of exchange vaults and into private storage where there's the export restriction situation. According to verified financial reports, major exporting nations placed export controls on silver in December 2025. That metal is trapped. It's not flowing to Western markets anymore. They're realizing that the silver they were counting on from overseas isn't coming, and the only place left to get it is from exchange warehouses. According to market data, near-term silver contracts are trading at higher prices than long-term contracts. That means immediate delivery is worth more than future delivery. And when that backwardation persists and widens, it's a signal that the shortage is getting worse, not better, because later might be too late. Now let me show you the smoking gun that proves this vault exodus is accelerating. Normally, when a futures contract approaches expiration, traders roll their positions forward, but that's not happening anymore. According to verified market analysis from January 7th, traders are doing the opposite. They're rolling backwards. Why? Because they don't want to wait. They want delivery now. Not in 2 months, not in 6 months, now. As one leading analyst put it, longs positioning aggressively to stand for immediate delivery, which will further drain exchange-registered stocks and further exacerbate the silver shortage. This is what happens when contract holders lose faith in the paper system and demand physical settlement. Either they allow delivery and watch their vaults drain to zero, or they declare force majeure and admit the paper market is a fraud. Let me put this in perspective for you with some historical context. Because what's happening right now has happened before, just not with silver. In late 2025, according to verified market reports, a dramatic event occurred. Within just 4 trading days in December, approximately 47.6 million ounces of physical silver were claimed from exchange warehouses. That's 60% of the available registered inventory at the time, gone in 4 days. Analysts called it a vault drain emergency. The system almost broke. The exchange had to implement multiple margin hikes to slow down the delivery rush. They raised margins to make it more expensive to hold futures contracts, hoping that would force traders to close positions instead of taking delivery. It worked, temporarily. The delivery pressure eased. Metal flowed back into vaults from other markets. But here's the problem. It didn't solve anything. According to market analysis, shuffling silver between different markets took the immediate pressure off, but it didn't magically create new silver. The underlying shortage is still there. The structural deficit is still real. And now the delivery rush is starting again. The registered inventory that saved the system in December, it's been cut in half, from over 200 million ounces down to 127 million ounces. And if another 60% delivery rush happens now, if 76 million ounces get claimed in 4 days like last time, the vaults go to 51 million ounces. Now let me show you why this vault exodus is not going to stop. Why the delivery pressure is only going to get more intense in the coming weeks. According to verified supply deficit data, the silver market has been in structural deficit for 4 straight years. The structural market deficit in 2024 alone was 148.9 million ounces. The world has consumed 678 million more ounces of silver than it produced over the last 4 years. That deficit had to come from somewhere. And it came from inventories, from stockpiles, from vaults. But now those vaults are running dry. The buffer is gone, and the deficit isn't shrinking, it's getting bigger. According to leading commodity forecasters, industrial demand for silver continues to surge. Solar panel production is exploding. EV manufacturing is accelerating. Electronics demand is growing. These industries need silver. They can't function without it. And where are they going to get it? Not from new mines. Mine production is constrained. Not from imports. Export controls are in place. So the vault exodus isn't a temporary phenomenon. It's the new normal. I'm extrapolating based on the verified data we're seeing. Over the next few weeks, delivery demands are going to continue accelerating. Traders are going to keep rolling backwards instead of forward. More and more, contract holders are going to demand physical settlement. The registered inventory, that 127 million ounces, is going to keep falling. 120 million, 110 million, 100 million. Every day, more metal leaves the vaults. Every day, the buffer gets smaller. Maybe a major industrial buyer stands for delivery and the exchange can't find the metal. Maybe the exchange just runs out of registered inventory entirely. Either they declare force majeure, officially admitting they can't deliver on their contracts, or they let the price run to whatever level is necessary to attract new supply. If they declare force majeure, the paper market dies instantly, and the price of physical goes to whatever the highest bidder is willing to pay. If they let the price run, we're talking about moves that make the recent volatility look like nothing. We're talking about $20, $30, $50 jumps in a single session. We're talking about silver hitting $150, $200, maybe even higher as industrial buyers compete for the last available ounces. Either scenario is catastrophic for anyone holding paper, and either scenario is generational wealth creation for anyone holding physical. Now let me show you the analyst projections, because this isn't just me saying this. According to major investment firms, it's absolutely possible for silver to hit $100 in 2026. One leading strategist told financial media that tightness in the physical silver market will support prices, with targets of $55 to $65 per ounce for 2026 as a conservative estimate. But some analysts are going much higher. They're talking about $75 to $100 ranges if current deficit trends persist. And that's just for 2026. Looking further out, top commodity strategists are projecting $375 per ounce by 2028. Not 50, not 100. $375 per ounce. And you know what? After seeing this vault exodus data, after watching 127 million ounces get hunted by accelerating delivery demands, after understanding the magnitude of the structural deficit, $375 doesn't sound crazy anymore. It sounds inevitable. So let me tell you exactly what you need to do right now. And I'm not giving you financial advice. If you own physical silver, coins, bars, rounds in your safe, or in allocated storage, do not sell. The real price is being determined by delivery demands at exchange vaults, and that price is going way, way higher. If you own silver ETFs, you need to understand your risk. Some ETFs are backed by metal held at major financial institutions, the same institutions that are custodying hundreds of millions of ounces. When the vault exodus hits critical mass, when delivery demands overwhelm available supply, do you really trust that your ETF shares will be redeemable for physical metal? Or do you think you'll get a cash settlement at a price that's way below what physical metal is actually trading for? The safest option is physical metal in your direct possession, in your hand. If you don't own any silver yet, you need to understand something. The window is closing. According to verified dealer reports, premiums are already elevated, delivery delays are already extended, and that's now. When the vault exodus accelerates, when the 127 million ounces start disappearing faster, when delivery failures start happening, you're not going to be able to buy physical silver at any price. The dealers will be empty. The mints will be backlogged for months. The vaults will be dry. Because in a few weeks, when registered inventory is at 80 million ounces and falling fast, when the paper market is in crisis, when the price is gapping up $30 in a single day, you're going to wish you had paid $92 today instead of chasing $150 tomorrow. Let me give you one final piece of evidence that this vault exodus is the real deal. According to detailed market analysis, the December 2025 vault drain event removed approximately 47.6 million ounces in just 4 trading days. That left registered inventory at approximately 127.6 million ounces. The market entered deep backwardation. The exchange responded with multiple margin hikes. That was 6 weeks ago. Traders are demanding immediate delivery, and this time, there's half as much registered inventory to begin with. The buffer that saved the system in December doesn't exist anymore. This is the moment when the paper market either admits it's a fraud or it lets the price run to levels that reflect the actual scarcity of physical metal. And you need to decide right now which side of that event you want to be on. Here's my final message to you. The vault exodus is real. The 127 million ounces of registered inventory is real. The accelerating delivery demands are real. The structural supply deficit is real. The backwardation is real. This is verified data from official exchange reports, commodity research firms, and market analysis. The paper market can pretend everything is fine. The mainstream media can ignore the vault exodus. The exchanges can implement margin hikes to slow delivery demands, but they can't change reality. And reality is 127 million ounces standing between the current system and total collapse. Major exchange-registered silver inventory stands at 127 million ounces. Delivery demands are accelerating. Open interest is moving into near-term contracts. The vault exodus is resuming. If you hold paper silver, seriously consider converting to physical. If you hold physical silver, don't let anyone convince you to sell. The real price is what desperate industrial buyers are going to pay when they realize the vaults are empty. The target is $100, $150, potentially $375. The timeline is accelerating. The vault exodus is happening right now, and you need to decide immediately whether you're going to be holding paper when the system breaks or holding physical when the price explodes. This is John A.G. Remember to like, subscribe, and share. Get out of paper contracts, get into physical metal before the registered inventory hits zero, before the exchanges declare force majeure, before industrial buyers start bidding the price to infinity. Do it now. Go, 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 go.